where could a reserve currency ever come from where the bond market would inspire the confidence the way the United States bond market has, which for years has been the most liquid, and especially a government that is going to be issuing $1 trillion in treasury bonds every single quarter, a government that is choosing inflation over austerity, this volatility, the mismanagement of the world reserve currency, the way that we have squandered our image on the stage, the world stage. We talk about this every day. And I think we've lost a good deal of that confidence in the rest of the world has in us. And so
join Andy Schectman as he explores global financial shifts in today's video. Bonds out, gold in. Discover how you can reshape your investment strategy with exclusive insights about gold's outstanding performance and silver storage. Join Andy Schectman for a conversation about the future of finance.
You know, over the last decade, nearly, or I guess you could say roughly the last decade, where cryptocurrencies have shown us the power of rapid appreciation, where suppressed interest rates, and really when we talk about suppression, to me, it's all about interest rates, which have created an illusion of prosperity in this country for years, where suppressing interest rates and then throwing massive amounts of money over the last few years, which we'll talk about in a moment, has created distortions in asset prices. They don't behave the way they have over the last several years. My mentor, Richard Russell, used to say, if you make 7% per year, you are a rock star. Well, the S&P 500 since the beginning of the century has averaged 7% per year, though I guess if you've been in an index fund just sitting there in the S&P, you are performing like a rock star. But lo and behold, the tortoise in this race, gold, has produced a 7.8% return, annual return, since the beginning of the century. And when you add into it, Dunnigan, the central bank and commercial bank suppression of the market, when you add into it the massive amount of money creation over the last several years, the Western market monetary expansion, massive. I think gold is well below where it should be, yet it continues to hold its own from a standpoint of value appreciation. And, you know, if you look at, for example, in 2020, gold was $17.73 an ounce average price. In 2021, that number was $17.98. In 2022, that number was $18.01. And in 2023, that number is $19.43. We continue to see it holding its own. And those numbers right there, you know, especially the last two, where it goes from 1801 to 1943 in 2022 and 2023 as an average price, comes in what is thought to be the worst environment for gold as of rising real interest rates. And so it held its own, very, 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 very much held its own. The market capitalization of the S&P 500 of the S&P 500 companies total is about $4.261 trillion. I think I'm right on that. It's about right. I think. The way that I wrote it down was 42,616 billion. So would that be, I think that would be 4,261.6 trillion. Anyways, point of it is that when you compare that to the market capitalization of GLD and IAU, which has a cap of 85 billion, that works out to 0.02%. So whether you're talking 0.5% of people owning it, or look at the capitalization of all the gold ETFs versus the S&P 500, in any respect, they are for all intent and purposes effectively zero. And so if the public wakes up and shifts just a few tenths of 1% of their allocation that was going into bonds, into precious metals, or into equities that were going into precious metals, it will, I think, you create a massive breakout in the price of gold in terms of its investment demand. But look, one of the things that I get pushback on when talking about the BRICS and their attempts to make a settlement currency, which is not the same thing as a reserve currency, is that, well, how could anyone ever, where could a reserve currency ever come from where the bond market would inspire the confidence the way the United States bond market has, which for years has been the most liquid and safe, stable market? Well, I mean, the first pushback would be after 45 years in 2023, the 10-year Treasury had greater volatility than the price of gold. Why? Because I think a good portion of the world sees what we just talked about. Little growth every single year with great liquidity. Well, isn't that supposedly what the bond market is? And from a historical context, holding government's debt as an asset, it has a very short history in a broader perspective. And especially a government that is going to be issuing $1 trillion in treasury bonds every single quarter, a government that is choosing inflation over austerity, a government who has let rates rise 11 straight times, destroying the value of those bonds in circulation, and now is talking about going the other way. This volatility, the mismanagement of the world reserve currency, the way that we have squandered our image on the stage, the world stage. We talk about this every day. And I think we've lost a good deal of that confidence in the rest of the world has in us. And so what I'm getting at is that when you see China and Japan and Saudi Arabia and Russia and all of these countries shed U.S. treasuries, what are they doing with their excess reserves? They're buying gold. And that's why you see over the last 2 years, the central bank's buying more gold than at any time in human history. And if we look at the performance over the last 2 years, what did I say it was? It was 1801 average price in 2022, 1943 in 2023. You go back over the beginning of the century, a 7.8% annual return not only beats the S&P, but destroys the bond market. So maybe they're taking a step back and saying, maybe we just load up on gold because that pretty well acts just like a bond. In fact, it's outperformed it. It has greater or lesser volatility right now, and we don't have to rely upon the honesty and the transparency of the West. In fact, there's no counterparty risk. But there's over 200 meetings in Russia this year, all about BRICS. But the big one is in October, where they are going to come back and present their findings. But in the meantime, they're all trading in each other's currencies with one another. Sure, the dollar is still the world reserve. Sure, the dollar is still the emperor who maybe has no clothes. But the point of it is that you are beginning to see the chipping away of the settlement status of the dollar in favor of local currencies. And ultimately, the BRICS could issue not only a common settlement currency or just a decree that if you want to trade with the BRICS nations, it has to either be in gold or in local currencies until we issue a common settlement currency. And maybe someday they issue a reserve currency or a bond market to challenge the West. But in the meantime, I think, and if you look at the numbers, they really don't lie, that gold could indeed represent that hole that would be in place if they shift away from taking the reserves or the excess. That was part of the petro deal. Will you value oil in dollars and take the excess and put it in treasuries? Well, if you remove the treasury aspect and put it into the other tier one asset, gold, with no counterparty liability and breaking free from the Western hegemony as they all want to do, to me, I think that's on the table. That's a playbook that I think you'll see more and more of here in 2024.
That wraps up our eye-opening discussion with Andy Schectman on Bonds Out, Gold In. We hope you gained valuable insights into the world of precious metals, gold's stellar performance, and the nuances of gold and silver storage. If you found this conversation enlightening, don't forget to like, share, and subscribe for more expert analyses. Thank you for joining us. And until next time, stay informed, stay invested.